Hello everyone, welcome to the Tim Booker channel. I wish you all a pleasant listening experience. Today, the book I'm interpreting for you is Principles for Navigating Big Debt Crises, with the subtitle, My Principles for Dealing with the Next Downturn. This book delves into a typical debt crisis, specifically the aftermath of the 2008 financial crisis. Ray Dalio, the author of this book, is a renowned investor and also the author of the best-selling book, Principles. The book has been well received and even won the prestigious Ximalaya Award. In 1975, at the age of 26, Dalio founded Bridgewater Associates, which has since grown into the world's largest hedge fund company. He himself has been listed among Forbes' top 100 billionaires. Within Dalio's investment wisdom, the theory of debt cycles holds a significant place. He carefully observes historical cases of debt crises, studies the trajectory of economic development and the patterns of economic cycles, and makes investment decisions based on his findings. His successful navigation of crises is evident, as demonstrated during the 2008 subprime mortgage crisis, where financial markets were in turmoil. Through his research on debt cycles, Bridgewater Associates predicted the crisis, avoiding losses and achieving considerable profits. The book we are discussing today is Dalio's systematic summary of his theory on debt cycles. In this book, he introduces the debt cycle model and conducts a detailed analysis of three typical cases: the German hyperinflation after World War I, the Great Depression of the 1930s, and the 2008 financial crisis. Additionally, he quantitatively studies and analyzes 48 severe debt crises that major countries around the world have experienced in the past century, fully confirming the validity of the theory of debt cycles. Since its publication, this book has garnered widespread attention and praise from various fields. Former Federal Reserve Chairman Ben Bernanke commented that Dalio's research provides us with innovative ways to think about debt crises and policy responses. Former U.S. Treasury Secretary Timothy Geithner praised the book as an outstanding contribution to understanding financial crises, providing a valuable framework that should serve as a guiding manual for future policymakers. Next, I will divide the interpretation into two parts. In the first part, I will explain what debt cycles and debt crises are and why debt crises are inevitable. In the second part, we will delve into the debt supercycle model established by Dalio, including the deflationary debt cycle represented by the 2008 crisis and the inflationary debt cycle represented by the German hyperinflation after World War II. Let's start with the first part. What are debt cycles and debt crises, and how do they form? First, we need to understand two fundamental concepts: credit and debt. Credit refers to creditors lending money, giving debtors purchasing power. Debtors commit to repaying the principal and interest in the future, essentially borrowing money from their future selves to use today. Every time someone borrows money, it creates a credit cycle. When all borrowing activities in society come together, it forms an overall debt cycle. Although Dalio dislikes borrowing, he believes that an economy that never takes on debt would miss development opportunities. If credit and debt generate substantial economic benefits, covering the debt, then borrowing is a positive thing. However, excessive borrowing beyond the capacity to repay can lead to a debt crisis when future income falls short of covering the debt. Let's use an example of buying a house with a loan to give you a straightforward understanding of a crisis. When we apply for a mortgage, we generally believe we have the ability to repay it because we expect our future income to cover each installment and interest. Moreover, the house may appreciate in value, and selling it later not only clears the mortgage but also earns a significant profit. On the other hand, the bank providing the loan evaluates your repayment capacity, reviewing your salary records, credit reports, and more. This way, we can enjoy our house without saving for the full amount, and the bank can earn high-interest returns, making both parties happy, and the risk seems manageable. However, both parties share the same optimistic view of sustained economic growth. If this judgment is flawed and events like unemployment or a housing market downturn occur, leading to an inability to repay, defaults become difficult to avoid. This is a debt crisis within an individual transaction. If numerous such transactions accumulate, the consequences can be dire, as seen in the 2008 subprime mortgage crisis. From this example, we can roughly understand the debt cycle, which involves excessive optimism, reckless borrowing, and defaults due to insufficient income. Dalio's cycle theory is based on this premise, but it becomes more intricate and sophisticated. In the early stages, loans generate a self-reinforcing upward movement. After borrowing, people's current spending increases, and as one person's spending becomes another person's income, the whole economy thrives. People's income rises, and investments drive up asset prices. As people's creditworthiness improves, they can borrow more money. Everyone expects the past prosperity to continue. However, overly optimistic expectations for the future lead to excessive borrowing. Once negative factors arise, such as tightening funds, stricter loan criteria, declining asset prices, or a slowdown in overall economic growth, the growth rate of debt and long-term debt costs exceeds the growth rate of long-term debt revenue. The demand momentum reverses, leading to the painful second half of the cycle. Borrowers can't repay their debts, income decreases, investments and consumption stagnate, asset prices drop, and the ability to handle long-term debt weakens further, resulting in a self-reinforcing downward movement. Alright, the above covers the main content of the first part. We have learned a simplified process of debt cycle formation, as well as the chain reactions and self-reinforcing processes within the broader cycle. Now let's move on to the second part. Dalio's model includes two typical debt supercycles, deflationary debt crisis and inflationary debt crisis. In a deflationary debt crisis, forces such as debt restructuring and fiscal austerity dominate. In simple terms, there is a scarcity of money in circulation, leading to reduced transactions and economic contraction. This type of crisis mainly occurs in countries that have significant debt denominated in their domestic currency, thus not causing exchange rate or international payment problems. Examples of this kind of crisis include the Great Depression of the 1930s and the 2008 subprime mortgage crisis. In contrast, an inflationary debt crisis usually occurs in countries relying on foreign capital inflows, accumulating substantial foreign currency-denominated debts. The dominant force during a downturn in this case is inflation caused by currency devaluation. A typical example of this is the severe hyperinflation in Germany after World War I. Both types of crises share similar basic patterns and can be divided into 6 main stages, 3 ascending stages and 3 descending stages. The ascending stages consist of the early bubble, while the descending stages consist of depression, deleveraging, and normalization. Now, let's delve into a specific case to see how these two types of debt crises form. A typical example of a deflationary debt crisis is the 2008 subprime mortgage crisis. We usually say that the crisis began in 2007, but to observe the complete cycle, we need to start earlier. In 2001, the bursting of the dot-com bubble and events like the 9/11 attacks caused a recession in the U.S. economy. To stimulate the economy, the Federal Reserve lowered interest rates, reducing borrowing costs and encouraging people to invest and consume, driving up asset prices and increasing wealth. This period belongs to the early stage in Dalio's model, representing a golden time of economic development and growth. From 2004 to 2006, the U.S. economy entered a bubble phase. Indicators showed excellent economic development with a stable growth rate of 3% to 4%, an unemployment rate of 4% to 5% below the long-term average, and an inflation rate of 2% to 3.5%, which was not too high. These indicators all pointed to a strong U.S. economy. However, during this time, debt levels also grew rapidly, with the real estate sector being the most critical area of the bubble. Due to increasingly loose lending conditions, U.S. house prices rose by 30% between 2004 and 2006. If we take into account the increase from 2000, the surge was a whopping 80%, the largest increase in nearly a century. Leveraging, or borrowing to buy houses, further boosted buyers' gains, and investors were generally bullish due to the ever-rising house prices, feeling increasingly wealthy. Financial institutions relaxed lending conditions, providing funds for the real estate market. As house prices continued to rise, lenders found that granting mortgage loans to buyers was a lucrative business because buyers' wealth increased with rising house prices, and they seemed unlikely to default on their payments. So, lenders continued to lower credit standards and issued more mortgage loans. At this point, let's not forget the name of this crisis, the subprime crisis. So what is subprime and what role did it play in this crisis? Subprime refers to subprime loans, which are loans mainly targeted at borrowers with low creditworthiness and weak repayment capacity. By 2006, the proportion of household debt to disposable income in the U.S. had risen from 85% in 2000 to 120%. The group with the largest increase in debt was the lowest income group, and a significant portion of that was subprime loans. These borrowers did not qualify for loans based on traditional standards. You might wonder, didn't financial institutions realize the high risk of these loans? How could they still issue them? Well, they did realize the risk, but they transferred the risk through securitization, packaging the loans into securities for resale. The realization of returns on these securities depended on the repayment of these loans. For example, there were collateralized debt obligations, CDOs, mortgage-backed securities, MBS, synthetic CDOs, etc. All of these could be collectively referred to as mortgage-backed securities. This may sound a bit abstract, but the principle is straightforward. The lending institutions handed these loans to investment banks, rapidly recouping their money. The investment banks then bundled these loans into securities, categorized by risk levels, and sold them on the financial market. The buyers of these securities only saw that the yields and ratings of these securities were high, appearing to be high-quality assets. However, they did not fully understand the underlying composition of these securities, or if they did, they believed that subprime mortgages were unlikely to have widespread defaults. Thus, the securities appeared safe. Consequently, the sales of mortgage-backed securities were booming, which, in turn, motivated banks to issue even more stimulative loans. Hence, subprime loans and rising house prices mutually reinforced each other, with the former expanding in scale and the latter reaching new highs. Now that we have a better understanding, the crucial question arises, will this self-reinforcing prosperity continue? We all know the answer to that now, but since we are focusing on the formation process of the debt cycle, we won't delve too much into the technical details. Having understood the basic principles, let's return to the broader perspective of the cycle. In short, after going through the self-reinforcing process mentioned above, the bubble reached its peak in 2007, which is the top of the cycle. Stimulative loans were the first to encounter problems, with an increasing number of defaults, and institutions issuing these loans started facing bankruptcy. Furthermore, many financial institutions held mortgage-backed securities, which were packaged from mortgage loans, and they were affected by the wave of mortgage defaults. The crisis began to spread within the financial system. Additionally, the earlier real estate bubble and crisis would spill over into other areas. During the bubble phase, credit increased significantly, and much of the funds flowed into areas that could not generate enough income to repay the debts, such as borrowing for consumption. When the real estate market weakened, it had a substantial impact on the real economy. For example, the total construction volume declined, wealth shrank, and housing-related consumption decreased. By 2008, data for manufacturing, retail, and employment were all poor, and the U.S. stock market continued to decline. Market panic spread, leading to the collapses of Bear Stearns, Lehman Brothers, Merrill Lynch, and insurance giant American International Group, AIG, in succession. Major corporations like General Motors also applied for bankruptcy protection. This marks the depression phase of the cycle. After the depression comes the deleveraging phase, which involves reducing the size of debts to restore balance to the economy and achieve normalization. In the case of the subprime crisis, the U.S. government took three major measures: rescuing important financial institutions, lowering interest rates, and printing money as part of stimulus policies. The measures began to take effect, leading to a decline in the unemployment rate, a rise in the stock market, and an overall improvement in the economy. By the second quarter of 2011, the U.S. real GDP had recovered to pre-crisis levels, and the economy was essentially back on track to normalization. Of course, the causes of the subprime crisis were intricate and multifaceted, and the above is a simplified model. However, from this case, we can see a deflationary debt cycle in real life, from the early stage of rapid economic development to the bubble phase and its peak driven by optimistic sentiments, new financial instruments, and loose monetary policies. Then, the bubble burst, panic spread, leading to the depression phase, and finally, the government intervened with measures like printing money to stop the bleeding, rescuing important financial institutions, and rebuilding market information, which led to the deleveraging phase, and ultimately pushed the economy back towards normalization. Next, I will introduce another typical case of inflationary crisis, which is the severe hyperinflation in Germany after World War I. This case involves more political factors. The starting point of the cycle was the First World War. During the war, Germany abandoned the gold standard, which allowed its currency to be freely exchanged for gold at a fixed rate. Leaving the gold standard meant that the currency issuance was no longer restricted by gold reserves, creating fertile ground for massive currency overissuance. At the same time, Germany accumulated a large amount of domestic and foreign debt. However, Germany was confident it could win the war and secure war reparations to solve the inflation and debt issues. Unfortunately, Germany was defeated and surrendered in 1918, resulting in the need to pay enormous war reparations. According to the Treaty of Versailles signed in 1919, Germany lost 12% of its territory, 10% of its population, 43% of its pig iron production capacity, and 38% of its steel production capacity. People expressed their concerns about the German economy by selling off currency in bonds, causing capital flight and currency depreciation. In response to the situation, the German central bank resorted to printing money to fill the liquidity gap. Although currency depreciation was unfavorable for imports and repaying foreign debts, it could boost exports, support domestic industries, attract foreign investment, and increase the value of assets denominated in the domestic currency. The stimulus policies took effect, and from July 1919 to March 1920, the mark depreciated with negative real interest rates, stimulating the German economy, the stock market, and the commodity market. The export industry flourished, unemployment declined, and corporate profits rose. Meanwhile, inflation cleared some of the domestic debts because the money became increasingly worthless, benefiting debtors. By the end of 1919, although economic activity levels were low, Germany's domestic war debt burden had decreased to around 25% of what it was in 1918, due to a tax reform that created new income. Economic activity began to recover, and to ease the escalating tension between Germany and the Allied powers invited Germany to propose a reparation amount. The exchange rate of the mark stabilized, and the economy entered a period of stable growth. In 1921, the cycle entered the bubble phase. Unlike the subprime crisis discussed earlier, this bubble was primarily inflated by foreign capital. Germany's economy improved during 1919 to 1921, with industrial production growing by 75%, and both prices and exchange rates remained stable. Germany became a hot spot for investment, attracting a large influx of foreign capital. Even people with no investment experience participated. This was one of the typical characteristics of the bubble phase. However, in May 1921, a political factor emerged. The Allied powers issued the London Ultimatum regarding war reparations, demanding that Germany pay reparations equivalent to 3 times its GDP and threatening the use of force. The announcement led to a sharp depreciation of the mark, which decreased by 75% by the end of the year. Inflation surged, with prices almost doubling. In June 1922, unfavorable news about war reparations came again, with France adopting a very tough stance and refusing to negotiate further, indirectly leading to the end of hopes for international loans. Additionally, Walther Rathenau, the then German foreign minister and a key figure in the reparation negotiations, was assassinated by right-wing extremists. These events further reduced people's expectations of resolving the war reparations issue, leading to the withdrawal of foreign capital. As mentioned earlier, about 1/3 of German bank deposits were from foreign sources. This withdrawal of foreign capital led to a severe liquidity crisis in German banks, resulting in bank runs. This further exacerbated the liquidity crisis because as depositors found it difficult to withdraw money from banks, more people rushed to withdraw, worsening the situation. German banks were forced to open only 3 days a week and informed depositors that they didn't have enough cash to meet withdrawal demands. Faced with this situation, Germany had no choice but to increase the power of the printing press. While this avoided a financial system collapse, it also led to a substantial increase in the money supply. From July 1922 to November 1923, the cost of exchanging 1 mark for $1 increased by 1.57 billion times, and prices rose by 3.87 billion times. Yes, you read it correctly, the inflation rate was calculated in billions. To illustrate this, let's put it this way. In 1913, 60 billion marks were in circulation throughout Germany, which could buy 1,000 grams of rye bread. By late October 1923, the same 60 billion marks could only buy the same amount of bread. This chaos caused immense suffering and trauma to the German people. By the end of 1923, the severe hyperinflation had caused tremendous hardship to Germany, with rapidly increasing unemployment, persistent high inflation, reduced tax revenue, food scarcity, stagnant normal transactions, and countless people suffering from hunger and homelessness. Everyone realized that the economic crisis would soon evolve into civil unrest and revolution. The Allied powers recognized that if they didn't reduce the war reparations, Germany would inevitably face economic collapse. In November 1923, the Allied powers agreed to suspend reparations and restart debt negotiations. Germany gradually pushed its economy back on track through the reorganization of war reparations, the creation of a new currency, and deficit elimination. In 1924, the crisis was finally mostly over, and Germany entered a brief period of recovery. Now, you might ask why the previous currency depreciation and printing periods didn't lead to hyperinflation, but this time it did. The main reasons were that this round of foreign capital withdrawal required a massive liquidity scale, and there was a significant change in public psychology regarding inflation expectations due to the foreign debt problem, making people extremely pessimistic about the economic outlook. This was an overview of the severe hyperinflation in Germany after World War I. Dalio summarizes 6 major characteristics of countries that are prone to experiencing this type of crisis. 1. Lack of reserve currency. Global investors do not choose the country's currency or bonds as a store of wealth. 2. Low foreign exchange reserves. There is little buffer to prevent capital outflows. 3. High foreign debt. If foreign currency interest rates or exchange rates rise, the cost of debt will increase. For large budget or current account deficits, these deficits continue to grow. 5. Negative real interest rates. Lenders cannot receive sufficient compensation by holding the country's currency or bonds. 6. History of high inflation and negative currency total return. People lack confidence in the value of the country's currency or bonds. Overall, crisis management is a daunting task that involves finding a balance and the right combination of policies to balance inflationary and deflationary forces, as well as social and economic performance, ultimately bringing the economy back to normal. Above is the main content of the book Debt Crisis. Let's review the basic concepts of the debt cycle and debt crisis. In the early stages of the cycle, loans generate a self-reinforcing upward movement as people's income increases, asset prices rise, credit levels increase, and more borrowing becomes possible. Once negative factors emerge, the trend reverses, and the painful second half of the cycle begins. Borrowers can't repay debt, income decreases, investment and consumption stagnate, asset prices fall, further weakening debt repayment capacity, leading to a self-reinforcing downward movement. The book also presents the typical model of the large debt cycle, which can be divided into 3 ascending stages: early expansion, bubble, and peak, followed by 3 descending stages: economic downturn, deleveraging, and normalization. The distinction between inflationary and deflationary debt crises lies in that the former, mainly occurring in countries whose debt is denominated in their own currency, does not create exchange rate or international balance of payments issues, while the latter often occurs in countries that rely on foreign capital inflows. 2 cases were introduced: the 2008 subprime crisis and the hyperinflation in Germany after World War I. Economic cycles are closely related to everyone. Behind the fluctuating economic data and changing stock market prices lie the celebrations and dreams, fears and despair of countless ordinary people. Understanding cycles and making the right choices amidst turbulence are important issues for everyone. This book, Debt Crisis, uses a broad perspective and systematic thinking to analyze complex economic events, summarizes patterns and models, and provides a highly regarded template for crisis response. Dalio, with his unique cyclical and structural theory, presents an analysis framework for the macro history of debt and the micromarket, showcasing the evolution of debt cycles over the past century, a truly fascinating insight. In conclusion, this book helps us better understand the interwoven clues of politics, culture, society, and more, sifting through the complexities to discern the patterns of development and the direction of trends. Thank you for listening to this book. Your support and attention are appreciated. Please subscribe to the Tim Booker channel, like this video, and share this valuable knowledge with your friends. Let's combine wisdom with practice, achieve our financial goals, and create a better future together. Thank you all.